Everyone. I'm Colin Nicholson. I'm a principal with Withum, based in Orlando, Florida. And this afternoon, I want to thank you for joining us and having a compelling discussion with our fellow panelists in conjunction with Florida Venture Forum about the venture capital industry today. And we'll get started. I'll go around, we'll introduce our panel, and each one of them will give you a little bit of background, and then we'll jump into our discussion. So I have Chris Maxwell with me from Morris and Manning, and Morris, Manning and Martin, pardon me, attorney based in Atlanta. We've got Mr. Terrence Berland, who's with Kiranaga Partners here in Orlando. We have John Rosenbaum, who's with Insight Ventures, based in Atlanta. And we have my colleague, Tom Angel, who's our head of financial services with Withum, who's based in New York. So gentlemen, please feel free to say a little bit more about yourselves, and we'll jump right into the chat. Chris, maybe you want to jump and go first.
Everybody, Chris Maxwell with Morris, Manning and Martin out of Atlanta. We're a full service law firm located here in Atlanta, but mainly we represent technology and technology-enabled business services companies around the Southeast. Currently, we have about 400 tech clients that we work with. We also represent funds that invest in technology companies across the country, from the Valley to New York, Boston, Chicago, et cetera. I also cover the state of Florida for the firm, and I'm a board member on Florida Venture Forum as well. So, Colin, thanks for having me.
Great. Thank you, Chris. And Terry, you're next to my screen, so we'll come to you next.
No problem. So Terry Berland, I'm a managing partner in an early stage venture firm called Kiranaga Partners. Background, 13 years on Wall Street, a number of years with McKinsey as a consultant. I actually started my working career in Orlando 25 years ago, teaching nuclear engineering for the Navy. Our focus as a company is what we call post-validated pre-commercial technologies, particularly in the advanced materials, advanced sciences, and a lot relating to space and things like clean tech.
Great, thank you, Terry. And John?
Thanks, Colin. Hi, everyone. John Rosenbaum with Insight Partners. Insight is a global venture capital and private equity fund based out of New York. I have a / Atlanta because I'm currently sitting in Atlanta as we're all spread out during the pandemic, but Insight kind of globally invests in all software for the most part, some consumer internet as a kind of analog of that, but 90% plus what we do is B2B software, ranging from kind of late stage venture through traditional private equity.
Great, thank you, John. And Tom, batting cleanup.
Thanks, Colin. Good afternoon, everybody. My name is Tom Angel. I'm practice leader for Withum's Financial Service Group. I've been focusing most of my time over the last 20 years on venture capital private equity funds. The firm itself and the financial service group handles venture capital, private equity, hedge, broker dealers, SPACs, 40 Act funds, and basically run the gamut and advisory in those areas.
All right, good stuff. I think we'll open up today with just getting some perspective in terms of what everyone is seeing in the venture industry. And maybe Terry, could you kick us off and just kind of give us your state of play in terms of how things are going?
Sure. So I think in 2020 for us, we've been around for about 5 years, and I think we were seeing a pretty consistent trend that there was more and expanding interest in looking outside of the traditional VC centers for opportunities. So we had the Rise of the Rest event, for example, that came through Florida a little over a year ago. And I think there was quite a bit of momentum as we headed into the year. And then when COVID hit, everybody basically went on pause, with the exception of technologies that were particularly relevant to addressing the COVID crisis. And so what we found, at least with one of our portfolio companies, is that it became a topic that everybody was willing to have when all the rest of the topics went on pause. What we are starting now to see, I guess it's 5 months, 6 months into this, is that the interest in getting back into venture investing is resurrecting itself with a lot of our LPs. I think what's happened in the stock market and the fact that, in many cases, they're actually back to where they were or even above is starting to get some people thinking that they want to take some money off the table in the public sector. And I think there's enough unique technology that's been stranded, if you will, over the last 4 to 6 months from a capital perspective, that there's a lot of interesting opportunities at valuations that you would not have gotten previously. So we're pretty encouraged about what the remainder of 2020 going into 2020 is going to look like. But we definitely had a pause, at least for what we saw over a kind of a 6-month period from kind of March to September.
Okay, great. Thanks, Terry. And Chris, with your client base and such, what's the news coming in from them?
Similar to what Terry saw, we saw some pause around the March-April timeframe. After that, any deal that was kind of in progress generally closed and found its way to get through. And then we kind of saw a pause over the summer. New deals of VC firms who had never met the prospective management team. And so a lot of my clients are dealing with that, sourcing and going after clients and meeting teams over Zoom, as it were. So they're feeling their way through it. But recently here, we've seen a lot of pickup in deal activity, both on the VC and M&A front. But the one thing that surprised me was valuations. I've seen a little bit different for what Terry's seen, at least with respect to any companies coming out of COVID with tailwinds. Valuations have maintained their current levels and some instances accelerated, which is not what I expected. I expected to see a lot more down rounds and distressed asset type scenarios, and we just haven't seen that yet. And maybe we'll talk about later. That's something we see next year. But that's been the one surprising thing to me, that some of the valuations have held steady.
Yeah, there's a few surprises definitely happening in the marketplace. And Tom, what's with the perspective in the Northeast and New York area with the client base of the firm? Anything to add?
Yeah, maybe we'll talk about new launches because that's what I see a lot of, surprisingly. And it's not just in the Northeast. We have prospects out in the West Coast, down South. There were a lot of new launches, which I was kind of surprised at. Now, whether or not they're going to be able to raise the capital, another issue. And it's been slower than normal. But there were a lot of people that thought that, it was a good time to try and raise a fund, and had some investment theories that they thought would fit into the pandemic issue. So where I thought it would be a slowdown for a period of time, it's still been hot and heavy in terms of new launches.
Great. And John, you're kind of more focused in the tech niche that's continued to be hot. What's been on your radar?
Well, would definitely agree with Tom. Definitely plenty of going public stories, right? We've had plenty in our portfolio over the last 6 months, which has been fantastic to see. I would say, I agree with Terry and Chris. The first wave in March, April was, let's invest behind things that have COVID tailwinds, which certainly B2B software in terms of cybersecurity and remote distributed workforce management and other attributes have plenty of COVID tailwinds. I think more recently, we've seen kind of a full understanding of how enterprise sales cycles have been impacted. So are getting a sense of who has COVID impact and who really doesn't. And so investment, kind of a demarcation of post-summer after Labor Day has picked back up tremendously. And I would say one other really interesting dynamic, not COVID specific, but certainly kind of geopolitical, is the fact that we're kind of staring down the barrel of a potential change in cap gains taxes, right? So we're seeing a lot of interesting on the LBO side of the coin, deals come to market that maybe are accelerated as a result of that taxation change at the end of this year going into next. So a lot of activity in this fall and going into the winter as kind of companies that had plenty of cash that didn't need to raise figured to wait for better opportunities as they kind of get COVID behind them. And then ultimately also with the interesting taxation change potential, I should say, that would allow for companies to kind of sell sooner in order to potentially avoid those higher rates.
Okay, and in the context of the government stimulus packages that have been put out, et cetera, I mean, what are the thoughts in terms of whether that has been perhaps a reason behind some of the more positive surprises, so to speak, that's been happening over the past few months, and And with one that is, we're still kind of waiting for something to happen going forward. Is that a positive, or are we okay?
So, I mean, for us, it's interesting. We had a lot of debate that we can go into detail around whether or not something like PPP was really for our portfolio companies. So ultimately, when we think about who's applicable for that kind of stimulus, is that us? Is that venture-backed or growth-backed B2B software companies? In large in part, I think there was some retribution for types of companies that took that money when perhaps they shouldn't have. And, time will tell the ramifications of certain actions taken. But I think it was helpful to at least have people feel like there was a backstop to some of the employees being able to stay on the firm. But for the most part, in our specific industry, I think a little less relevant than perhaps others.
Okay, and Terry, you're on the front lines with your companies. What's your perspective in terms of stimulus and whether it was a contributor or not?
Well, so we have a kind of a bipolar portfolio. So we had a couple of companies that were extraordinarily benefited by what was going on, where we didn't even think about the application because one of the requirements was that it had to have a negative impact, and we didn't. For a couple of our others, actually, it was pretty critical. So given that we're pre-commercial in most of our investments, we would be looking for the next round of capital, and with what was happening with COVID, that wasn't going to occur. And so the PPP money actually gave us a nice bridge between where we thought we would be in terms of being able to raise the next round of capital and now where we are. So it carried us through the summer and into the fall, and in a number of cases actually allowed us to get enough commercial activity going that we could carry all the way into next year. So for at least a couple of our portfolio companies, were it not for PPP, we probably would have shut them down.
Okay, interesting. And pivoting now to regional discussions, we've got a pretty diverse group here in terms of the eastern part of the country. How's the perspective with venture and business growth in the Northeast versus the past, and how are we seeing things down here in Florida and in the Southeast with respect to the environment? Maybe Chris, I can ask you. You're based in Atlanta. You've got a good client base. What's your perspective in terms of those regional differences historically versus where we might be headed in the future?
Well, I think both Atlanta and Florida are very similar in that there's a dearth of capital here. So obviously there are funds in various stages, but a lot of our clients end up getting funded from outside this part of the country. So it's interesting to see that, I think now more than ever that funds outside of the Southeast are looking to come in and make investments in quality companies in the Southeast and companies that are doing well down here. And those are whether they're backed by a Carinaga or another earlier stage fund. They're coming down and they're looking for the best possible portfolio companies outside the coast, right? So I don't think much has changed. I think there's still a lot of interest in Southeastern companies. I think the ones that have benefited or coming out and growing are getting just as much attention, if not more. I had a call earlier today on one of our companies that had 60 funds chasing after them because a lot of funds are sitting on capital and are excited to get back to investing, right, if they took any pause. And so we're seeing a lot of activity. And
Terry, you and I have had discussions about this topic before. You've had a perspective. You've been here for a while in Florida. It's sometimes a challenge to kind of get attention from capital sources in the region. Is there any developments on that? Has it changed, or do you see things getting better?
I think the capital access is getting better, but very much for what Chris described is I think there's more capital from outside the region that is now starting to appreciate the opportunity sets here. The runway is much longer for your dollar investment. And you're able to, where you couldn't point to them, even 5 years ago, you're now able to point to like the most recent Luminar monetization, and you can see, unicorn valuations that are happening from companies that are sitting in Florida. I think that the remote work mentality has also opened up that you don't have to be co-located in order to be successful, particularly for a lot of these different business models. And I think that actually lends itself again to Florida being a great place for those companies to be. I think the capital, the local capital, is still every bit as much a challenge now, if not more so, because in the world of kind of relatively risk-averse capital, which a lot of what Florida is, COVID made them more risk-averse. And so you've got kind of those people who I think are thinking more holistically about their portfolio. And if they're somewhat risk-seeking, they're looking at places like Florida and Georgia and others as great return on investment opportunities. And those who are mostly interested in protecting their capital are just staying out of the asset class, period.
John, what's your perspective on that?
So, I mean, I'm proud to say we've been investing between the coast since inception. I mean, if you look at, or I sit in Atlanta, in our portfolio, we have OneTrust and Sales Loft and QA Symphony. You know, the list is pretty long. Investment was a great exit in the last couple of years. You know, I've worked with companies in North Carolina and in Georgia and in Florida. In fact, you know, Encino's worth highlighting. Wilmington, North Carolina. Would you have ever thought that that's the city that produces the highest priced multiple on a vertical SaaS company in history? It's crazy to think, but the reality is that software can be built anywhere. So this is from my perspective within the software world, but certainly fully agree the continued push for remote and distributed work, willingness to invest over Zoom as opposed to maybe meeting in person. But I think, you know, not to toot our own horn, we've certainly seen the value of companies produced outside the coast for many reasons, right? Lower cost bases, better culture development, because there's not a lot of revolving door of engineers. You can really cultivate a talent base that stays with you for a long time. A lot of interesting benefits to building, particularly software companies in the Southeast that we're really excited by.
And just to kind of continue on that with respect to talent and the software industry, you know, what's your thoughts? There's been discussions about how, because of the pandemic interrupting attendance of students on campuses and things like that, and even with foreign students coming back, et cetera, do you see, is this something that is just a short blip in the development of talent in the country, in the software industry, or is this something that we need to think about longer term?
Well, it's really fascinating, right? If you look at what some of the biggest, you know, FANG tech companies have done, for example, I think Google put out within the last 12, 18 months, like willingness to not hire folks without college degrees, or willingness to hire folks without college degrees. And that's an interesting point about the democratization of education with respect to technical talent, right? In our own portfolio, we have Udemy and Pluralsight that are absolutely incredibly good platforms for folks to learn how to code better, even how to get started coding. And so I think ultimately what we'll find is there's going to be a much more merit-based approach to cultivating technical talent. You know, even on the skill assessment side, things have gotten much stronger, such that you can understand if someone has the chops pretty early on in an engagement, such that, you know, a degree from a college may be less relevant in the coming years. So I do think it's a blip coupled with a kind of longer term meritocratic trend toward skills-based approaches as opposed to degrees-based approaches. But, you know, it'll be time will tell with respect to how companies are willing to accept folks without that traditional pedigree in training.
Great, thanks, John. And Tom, with the tax environment up in the Northeast, and we keep seeing news about, I think New Jersey just came out and announced they're looking at a tax increase at the state level. Do you see the spread continuing between the North and the South? And we've talked about how there's already been some investment management firms that have been setting up down here to take advantage of the lower tax environment.
Yeah, I mean, there's been a lot of movement. People always look for, you know, places where that may be more tax advantageous. You know, but that becomes a personal consideration depending on where family is, things like that. I think the biggest driver to move people and move funds around anyway, you know, prior to the pandemic, and I think this will only kind of increase it, is, you know, the ability not to have to be located in a certain place. I mean, originally you needed to be in Silicon Valley or Silicon Alley in New York, and Boston popped up, you know, and now you have places, Carolina, Austin, Texas, Denver, Colorado, Michigan. So you have different places where good tech schools are. I know John said about, you know, having issues in terms of trying to hire people because so many people are trying to bring in engineers, so now they're taking people without college degrees. But I think that was a driver. People didn't want to move and they'd rather work in those locations, and so that's where the money wound up going, and that's where some of the funds wound up setting up. So I think the money goes where the businesses are, to the extent that that's where things are based. If they can move it to a lower tax state, they may do that. But David Tepper moved down to Florida, and now he just bounced back up to New Jersey. So New Jersey's happy that it gives them some more tax dollars. But and his reason was family to move down to Florida and also family to come back. So I think that's more of a driver. But if you have the opportunity and you're not tied to a location, I think a lot of people are looking at lower tax states to move to.
Good stuff. And maybe we can talk a little bit about new launches. You mentioned that new launches were coming back into favor again, et cetera. I mean, if you were advising a new manager right now, someone who's thinking about trying to launch their own business in terms of venture investing, anything to offer in terms of what might be different today in doing that than last year? Chris, maybe I'll start with you.
Yeah, I think it's always been tough to start a new fund, right? And going out, you're competing with for the LP dollars of all the other funds that are out there raising their second, third, fourth funds. I mean, I know a lot of LPs still won't even look at a first-time manager. So, I don't know a ton that are going out right now, but maybe Tom's better to speak to that. But I imagine it can't be an easy environment to be going into, especially, with a lot of uncertainty out there around the election, a lot of uncertainty at the carried interest law. And, it's just going to be a little bit more difficult, unless you have a track record to raise that next fund. But love to hear what the other panelists think.
Yeah. Terry, what are your thoughts? You've been there, you guys have launched, et cetera. And what do you think about the environment then versus now?
Well, it's interesting because we actually, we have launched as a company, but we just launched another fund right at the beginning of the year. And so what I think we are consistently hearing is that you can't just be part of the asset class. Right? There has to be a much more precise and robust investment thesis in terms of where you're investing. And then you've got to really size whatever you're trying to raise to the scope of opportunity that you're going after. And so I think what we're seeing, at least in the capital raising, is that there are venture funds that are being raised that really aren't venture funds anymore. They're much more high-end growth funds or even really PE funds. Right? And that's just mostly about asset gathering, and that's a very different sphere than kind of your early stage, mid stage true venture. And there you need a real investment thesis. And whether you've got an investment track record or you just have a really deep management team that can describe why you think the opportunity set is there. At least we're seeing that the days of just describing I'm in the venture capital space, please give me money, are kind of over. So you better be able to articulate very, very clearly why you believe and have proof points to support it. And where we've done that, both in terms of direct company investment and then this new fund that we're raising, we're getting a lot of positive feedback. And it's not like capital isn't out there, but it's looking for something differentiated.
Understood. And John, I saw you nodding along. It sounds like you've got a similar perspective.
Well, I can't say I've done the fundraising motion outside of helping with some of Insight's efforts, which is very different than launching a new fund. But I'd say I have a few former colleagues and friends that have gone through the process. And I would just add on Terry's kind of input that it's not only focused, laser sharp focus in terms of really where you're going to deploy capital, but also your differentiated origination strategy. So how are you going to find deals? What is your lead flow engine? Is it a brute force analyst driven model? Is it a differentiated market perspective, your connections, whatever it might be? The folks that I know that have gone through the process in the last 12 to 18 months, that's really been where the rubber's met the road with a lot of their LP interest is, are you really going to get in front of the deals that I want to be exposed to? And so not only just defining where you're focusing, but how you're going to go win is pretty crucial. And again, I'm commenting from the cheap seats, but that's what I've seen for outside looking in.
Yeah, so a much more robust and thorough business plan, basically, in terms of how you're going to do this and pull it off.
Something like that, yeah.
Yeah, okay, good. And maybe we can cover off a few things in terms of risk exposure now in the present day, and each of your roles and what you're doing. What are we thinking about in terms of risks that are different today than what they were even 6 months ago? I mean, Tom, in the context of working with clients and performing audits, et cetera, and is there anything that with respect to valuation estimates and things today that that are a little bit more thought-provoking than what they may have been?
Yeah, I mean, obviously, valuation is the main risk on the audit, which is where we spend most of our time dealing with the audit. It seems like things have leveled out. If we would have had this conversation back in April, we would have all been discussing, how everything went down to bottom, and but back in April and May, we probably thought this was over in another month or so. Now we're 6 months into this and realize it's probably going to be longer than that. So valuations are, probably going to be a little tricky at the end of the year. Take a look at it. There's winners and losers in this environment. So where you would think that maybe everything would be down, not necessarily so. There are some things that may be way up just because they're a perfect company to be operating in this environment. So we have to take a closer look at all of our venture capital's portfolios, see what they're invested in, see what where they've been in terms of milestones, things like that. So that'll be a big focus on interim going into the end of the year, is to take a look at those type of things.
And Chris, are you seeing any changes in terms of offering memorandums and investment management agreements and things of that nature in terms of the fund manager and how the LPs are moving?
Not on that side. I would say more on the deal side. It just depends. I think it's the haves and have-nots, right? If there's tailwinds coming out of it, you're getting better terms, better valuations. Nothing much has changed. If you're stagnant, not growing, need capital, I think the terms and the fund's risk profile have changed. We're seeing a lot more structure in terms of liquidation preferences, things of that nature, if it's not a right down the middle growing technology company. So there's just different ways that we're seeing funds manage risk. I think the one thing is that there's competition for the deal. Deal terms aren't really going to change that much. I mean, they're going to stay pretty. They're going to keep the investors honest. I think where you're going to see more protection, and maybe down the road is once that PPP money runs out and companies need capital, they might have to be more flexible on their terms. And I think at that point you're going to see funds get a little bit more aggressive on their terms.
Gotcha. And with respect to going downstream and making investments, Terry and John, I'll throw this out to you. We mentioned a little bit about virtual due diligence, and there was some hesitations initially. I remember back in the spring of well, how is this actually going to work? And you had some people making grand statements that they just were not going to make an investment if they couldn't go and quote unquote shake hands and stare somebody in the eye before writing the checks. What's your perspective on that now that we're looking at this as a bit of a longer term situation? Terry, I'll start with you.
So I don't think that, at least for us, we've ever been unwilling to invest without being able to see eye to eye, particularly because a lot of what we're investing in and the stages that we're investing in are things that we can do diligence, including the quality of the intellectual property, the validation of whether the technology works, and that's our downside protection. And then, having been part of global organizations like McKinsey, where I worked with a lot of people that I never actually, met in person, I still think you can get a lot, not ideally as much as you would in person. But, as we see here, we haven't actually been in the same room in quite a while, And yet, I think that you can still get a lot of this. The technology has gotten better as well, right? It's not just the same, Polycom in the middle of the room. You can see people, you can see their face, you can see how they engage. And so you get a lot more of the nonverbal cues than you might have gotten otherwise. For us, actually, I think what we have done, though, is that we do have a higher conviction level in our investments in this world. And so, we've moved the bar up. We'll write fewer checks, but we're going to write bigger ones. And I think we're comfortable with that because it gives more runway for early stage companies. And I think it goes along with the idea of some of the more risk associated with the due diligence. We just set the bar higher.
John?
Agreed that there's a lot, especially investing in software companies, you can get in a virtual diligence given the asset-light business model. I would say one tidbit, I suppose, is it is bidirectional. So we lost some deals where we were going to fly out to XYZ city, but hadn't had a chance to. And entrepreneurs, in fact, said, well, I met these other people in person. So that was more March, April timeframe where we actually were the ones who lost out. I would say it increasingly is irrelevant. Per Terry's point, I fully agree. I think we can do a lot of diligence virtually. The feeling of trust and understanding, even like small jokes or the equivalent of going and grabbing a drink or grabbing coffee, is not ever replaceable with Zoom, but it's getting closer. There's a convergence of the effectiveness. So I think we're doing more and more. And I think a lot of what we diligence, Terry's point, is technology and is customer satisfaction, especially at the growth stage, which is generally done not in person anyway. So once we got over the kind of initial hump of diving into the water and being willing to do these, I think the floodgates are wide open as far as doing purely virtual deals.
And so from the founder and entrepreneur perspective, then, I guess the concerns that may have been there before about the inability to travel and have potential capital suitors come and go through that process now, they can pivot. What is there, other than simply going from a in-person meeting to a video call, is there anything else that they should be anticipating in terms of how that due diligence process might be changing compared to previously?
I think in reality, what's happened is it's shortened cycles. So because we're not waiting for the optimal timeline where someone's in the same city at the same time, right? You have to book a flight for 2 to 3 weeks out. What we've seen happen is a willingness for when entrepreneurs are fundraising to just move really quickly. We pride ourselves in being able to move quickly and kind of give transparent feedback along the way. But what we've seen is, okay, well, if the next step is not a meeting in person in 2 weeks and we can get it on the books for later this week or early next, why are we waiting, right? And so I think what we've seen is a little bit more faster timelines for folks who are actively raising, puts pressure on us as investors, because ultimately, if everyone's moving as fast as they can, it's all about who's willing to get on the phone, just like it was all about who's willing to fly before. But naturally, this can happen within 12 hours, not a week, right? So a little bit of a shortening of the cycles, I think, is the biggest observation.
Okay, good.
And one other thing I would add is I think it has raised the bar on the quality of communication. And so I think, when you have the time when people are kind of in location that stretch things out 3-4 hours, you go to dinner afterwards, you can be less focused and less precise when you've got a 1-hour call. I think you get to the point a lot quicker, and you're either sufficiently good at telling your story or you're not. And if you're not, I think the no's are coming faster as well.
Understood. Switching to exits now, going the other end of the spectrum. Tom, Withum, we've seen a lot of activity in the SPAC market, and I've had conversations with managers who are traditional private equity, private credit, who I would never really think that would be interested in SPACs, and everybody seems to be wanting to talk about SPACs right now. Can you offer some perspective as to why have they maybe eclipsed IPOs in popularity for monetization, and maybe just give us a little bit of SPAC 101 in terms of how one might go ahead.
Sure. So, SPAC's been around for a long time. probably back in the 90s, and it used to be just called blank check companies, and had some negative events that occurred around them, and mostly foreign sponsors for some of these, and there were issues and things that went on. But lately, you're getting a lot more quality, the quality of the managers that are starting these, which helps drive fundraising for these. I think they've become popular because they're one-off deals. So whether it's a PE or VC fund that you would invest in, usually tied up for 10 years plus. These are one-off deals. They have to be done within 24 months. The downside risk is virtually nil. So when the SPAC has all its investors, and then when they find a deal, the investors outside the sponsors get to vote. If they don't like the deal, they can get their money back. So very little downside risk for the investor. And then I think it's easier to go public for a private company. Just one. To take your own company public is probably over a year and a large dollar cost. A lot of disclosure issues. If you haven't been PCAOB audited, you have to have that done as well. And not that you don't have to have that done if a SPAC acquires you, but that's part of the process to get to that point. To roll up into a SPAC is, basically you work the deal out. It can be done rather quickly. And the deal is basically worked out between the sponsor and the selling company. The sponsor typically keeps 20% of the underlying investment after that deal is done. But there's a lot less upfront disclosure and road shows and running around trying to convince various investors, investment banks to take on the offering and also raise the funds for that. So Ackerman, who raised a $4 billion fund, saw him have a conversation on one of the business shows and said that if a SPAC would have acquired WeWorks, they probably wouldn't have gone through the issues that they went through for the public filing. Now you can argue whether or not that's a good or bad thing, that maybe they shouldn't have gone public anyway, but a lot of that scrutiny that went on wouldn't have been as much because the turnaround time and the lack of the road shows to raise the money wouldn't have been there. So that's all the positives to it. Sometimes the investors can get diluted if they need more money to do the deal. So a SPAC has to spend 80% of its raise or more to do a deal. If they have to bring in outside money, they usually get PIPEs, private investment in public equity, which may or may not wind up diluting some of the investors. So I think that's the reason why they've become hot lately. And they're looking for growth companies. I mean, Ackerman was talking to Airbnb to try and do that deal, but they decided to pass and do an IPO on their own. So there's a lot of positives for it. I think over time, the SEC, I've listened to Jay Powell talk about them. His conversations are, he doesn't have a problem with it. He thinks they're another vehicle in order to go public. What he will emphasize, put some emphasis in is the disclosures. So they are beefed up a little bit more than maybe where they are right now in order to be equivalent to what you would have to go through on a public offering.
Gotcha. Thank you, Tom. And Chris, with your clients, and what are you seeing in terms of exits, transaction pricing? We've talked a lot about making investments. Tell us what you're witnessing on the other side.
Yeah, so our clients generally are a little bit, smaller. We don't live that SPAC the SPAC life. So we're more trading our clients to John's type of fund. We did one with them last year. So it's usually in Atlanta and the Southeast, either, sale to a strategic, but now we're seeing 95% probably financial buyers. So usually it's either going to be a minority or majority recap where the founders either take some capital off the table and put it in your pocket and then put some on the balance sheet, or in the majority recap, they're rolling over a percentage of their ownership. A fund like John's comes in and, takes over, management, or takes over a lot of stuff, but the management still runs the company, and founders roll, somewhere between 20 and 40%. So that is, generally what we're seeing. Maybe 2-3 years ago, you'd see more strategics, and certainly strategic deals are out there getting done. But just with the amount of dry powder out there, with the financials and the PE funds, that's dominating the market right now. And the strategics we do see are usually backed by larger PE funds. So that's the exit we see, here in the Southeast. Certainly there have been a few IPOs here and there, but few and far between. It's the majority of the M&A market where founders are getting no liquidity.
Okay. And John, you've been involved in a few IPOs, correct, over the past few months. Is there any change in how that's gone compared to pre-pandemic, or what are your thoughts?
Well, certainly the IPO process was impacted in terms of what was a roadshow is now testing the waters virtually. So that was in that specific niche process within the broader world of investing, definitely a big change from the fundamental, very stringent way IPOs used to be. I think now there's willingness to do it in what is unorthodox against history, but will probably be the way people do things. Won't name names, but certain management team members across our portfolio were thrilled to not have to travel city to city to city to city over the course of 3-4 weeks, right? To be able to do it virtually and just as effectively is great. And I think just one comment on the market being, there's a relatively insatiable appetite for high quality software businesses. So to the extent that we've had successful IPOs is a direct impact of the beginning of our conversation today, which is if there is a COVID tailwind, investors are looking to go into that as opposed to something that could have a catastrophic event when the music stops and nobody knows where the markets turn. So I think ultimately for high quality software businesses, the IPO market has been an incredibly useful tool to really go out, raise money, and create value for shareholders and obviously management teams alike.
Okay. And Terry, with Karanaga and your companies, you're not really sure if you guys had any exits yet. What's your perspective in that market and how to proceed now versus?
Well, it's interesting. When we get invested, typically we're looking for 1 to 2 more rounds behind us before an exit. So the majority of our portfolio is still young enough in maturity, but we actually have had 2 exits. Both of them happened at the tail end of last year, and we've got one that's in a transaction for an exit this year. What I've actually seen, I think, and you talk about kind of the COVID tailwind, is there's starting to be an appreciation that there is going to be a new normal. And contrary to the swine flu or the Ebola crises or whatever that kind of came and went, this, I think, for a lot of these companies is what 9/11 was to things like building security. It just won't go back. And so as people are starting to understand more and more what the new normal is going to look like, what we're starting to see, which is interesting from a potential exit perspective, is a lot of the corporate venture starting to be more active as opposed to passive in looking at potentially acquiring capabilities to help their core business. And I think for at least some of the technologies we have, that opens up an exit sooner than we might have thought. We haven't seen one close yet, but we're having conversations that we didn't have 6 months ago.
Mm-hmm. Good. Tom, anything to add in terms of your client base and how things are looking from an exit standpoint?
I think things have slowed down early. I think they've started to pick up, and some of the clients have gone public, some of the investments. some of our clients are in the lemonade deal. So there's some activity on the winners. Obviously, the other types of investments are kind of hanging on and kind of in limbo until we see what happens.
Switching to another topic, very, very big, broad topic in terms of popularity this year at the larger kind of global fund level, and especially overseas, and that's ESG and sustainability. With smaller businesses in the venture space, I mean, I'll open it up to Terry and John. Is that something that your perspective is changing in terms of looking at the sustainability elements of a business model and some of the wins that are pushing in terms of considering factors like employee practices and sustainable materials being used? I mean, I know in tech it's not really a huge capitally intensive business per se, but there are some things such as if there's cloud server farms and such, and how much, where they are, how much energy they're consuming, all of those things. What are your thoughts on that in terms of the environment today and maybe what it might look like in a few years' time?
Sure, I'm happy to start. I think for us, I think I'm going to be off by 18 months, so give me a big buffer. But I think around 3 years ago, 4 years ago, we added ESG due diligence as part of every deal we do. So we look through all these, and obviously to your point, Colin, right? There's not a big carbon footprint that software companies are putting out there beyond servers. I think ultimately though, the push came both from our own GPs who said this is important to us, as well as our LPs who want to make sure we're investing in companies that do the right thing. Just blanket statement, do the right thing. So whether it's environmental, social, or the governance of the company, we want to make sure that we've looked and we know eyes wide open what's going on. And so we've added that to our diligence process as a fundamental pillar of making sure we understand the company well. I think one interesting thing is obviously overall diversity, hiring, and inclusion that we're continuing to push toward as well. And you'll see broadly corporate social responsibility, I think, be a part of every investor's mindset when it comes to, yeah, this company could make me money, but are they the right people? Are they doing the right things in terms of volunteerism, in terms of charitable donations, in terms of hiring practices that make me proud to be their investor? And I think that will continue to tick up and ultimately be a big factor of everyone's diligence in 2021 and beyond.
Good, thanks, John. Terry, what's your perspective?
Well, so I think given the nature of when we tend to invest in companies, there isn't a lot to due diligence because in most cases, the kind of corporate processes, corporate structure is all still to be defined, right? We're generally catching people when there's 2 or 3 folks involved and they've got a great technology idea and they're trying to build a business. So I think for us, it's less about due diligence and more about just building that in as part of the way we work with the companies from the ground up. So we're very keen on kind of social responsibility, on good corporate governance, making sure the investment documents are right, making sure the corporate governance documents are right, making sure that we've got ethics elements in people's employment agreements. But on the broader topic of like the ESG and particularly like the sustainability and I'd say topics along those lines, we tend to just invest in those areas because we think they're great business opportunities. So it's not an or for us or an ancillary, it's core. So when you look at our portfolio, I mean, we have ag tech where we're trying to feed the hungry. We have water tech where we're trying to clean up, contaminated rivers. We have germ tech where we're trying to deal with COVID. We have carbon fiber companies to be able to minimize weight and make things substantially more sustainable for space flight and that kind of stuff. And so it's more a core part of our investment than it is something we do alongside. And we're doing it because we believe that you can both do really great things and do well at the same time. And we've at least found for Central Florida, where we do a lot of our investing, there's such an overlap between those topics and the kind of companies we find here that it's less a secondary thing or an ancillary thing we do. It's core to what we do.
Yeah, and that's really been we've gone from impact investing and corporate social responsibility now to the concept that strong sustainability elements to a business model will differentiate financial performance over time. So it's, to your point, it's kind of a core element now of a successful business. Chris, any perspective on that?
I don't have much to add on that one, sorry.
That's all right. Okay, well, we are 5 minutes away from wrapping up here. If you don't have any questions, please submit them. But in terms of our wrap up, we touched upon a little bit before in terms of tax changes and regs and things that may happen as an outcome of the upcoming election. Let me throw it around to the group, and if you dare bring up a crystal ball or even just your thoughts in terms of what we may see one way or another in the environment here in a couple of months, as far as how it may affect what you and your constituents experience. So let me start with John.
Yeah, so sorry, I kind of spoiled this question by talking about it earlier, but I think the broader political environment will lead to an interesting caps gain tax impact, which is yet to be determined with the presidential election and obviously the state of the Senate. But I think ultimately that'll be the biggest driver of how large scale assets, traditional LBOs that are both driven off obviously leverage, but also just big chunky deals from sponsor to sponsor will be maybe accelerated in the part of this year to avoid some of that taxation.
Okay, and Tom?
Yeah, I would agree with John on that. I mean, we've seen this in the past where either the tax law change was going to go up, so everybody was trying to get their deals in prior, or the taxes were going to come down, and maybe deals that were supposed to close earlier got pushed into the next year. So it definitely affects it, especially, if you're talking anywhere from 10 to 20% more in terms of tax that you'd be saving. So I think as soon as, and you may even have a shorter window, because the election's November 4th doesn't mean that that's when we'll know the results. So this may drag on to early December. So people are going to have to be guessing, and you may have attorneys being able to do double work because they'll have to set up deals to happen in December, and then they don't need to happen. So they'll get some more work to it. But that's kind of what you'll see depending on how things turn out.
Okay, and what does our attorney think about that, Chris? Over to you.
Absolutely what I'm seeing. Since Labor Day, the amount of M&A activity has increased, 4 or 5-fold. It's hard to keep, enough staff around to execute on the deals we have. We see more coming down the pipe. We see a lot of deals that didn't go out this summer deciding to go out now, in addition to the tax issues. So it's going to be a very interesting fall going into the end of the year. And then I think it's going to be interesting next year once PPP money runs out. Everybody drew down on their credit lines. So the companies that aren't growing, what that does to the M&A market, what it does to their capital raising efforts. So I think that's going to be another interesting thing as we head into 2021.
Okay. Terry, what do you think?
At least for our portfolio, I think the tax implications are less critical to us just given the stage of the companies, but the regulatory environment is critical. And so what I think is going to happen is right now you're seeing some hesitation in terms of whether I'm going to try to run down the left path or the right path because I don't know which regulatory environment I'm going to run into. And so I think post-election, when a lot of that ambiguity goes away, regardless of which way it resolves, I think it clears up the strategic path for some of these early stage companies. And so I think they will be able to run faster, and they'll actually know which side of the road they're trying to run toward. But the tax side of it is actually not a big thing, at least for our early stage companies. Regulatory is critical.
Right. Yep. Okay, we've got one question here just before we close off. So, and the question is, how is cyber affecting investing? Are funds doing more due diligence around cyber? John, that's kind of your wheelhouse in terms of tech. What can you offer with us on that answer?
Sure. So I would go multifold. we invest in software companies. So the cyber posture is this software package on behalf of this vendor's end customer safe and secure. That's always really important point of diligence, right? Because data integrity and security for any application or infrastructure or software is of the utmost importance. Otherwise, you can't sell it fundamentally. I would say the counter or a different kind of answer to the question is really, and we've seen just a massive influx of high quality cyber companies see a lot of tailwinds. And as a result, we as a firm have, I think, made in the last few quarters, over 5 cybersecurity specific investments, and on the backs of a lot of what we've already done, because of the fact that there's an incredible need for a new cyber posture when all of your employees across a corporation are distributed. That just presents new challenges and ultimately leads to new ways for the bad guys to find a way in. And so ultimately need the good software to go protect against that, which we're trying to invest behind as much as we can.
Good. Yeah, thank you. And Terry, leave it to you to close out. Do you have any perspective on that topic, cyber investing?
Well, for us, again, given the nature of the companies we have, I don't think it's so much about cyber investing. It's about finding cyber partners. Because when you're an advanced materials company or you're an advanced science or an advanced manufacturing company, right, cyber is not going to be your expertise, but it is becoming so critical that you have to be able to protect yourself. That we're spending a lot of time just trying to figure out how to find the right partners, which I think actually opens up a huge opportunity for John. He's investing in all the partners that we're using for our companies. So it has to be, if you're going to be sustainable, build a company that's going to have a monetization at some point, that you're thinking about that, and in a much deeper and richer way than you have before.
Great. Okay, well, we are at our time. Thank you, Chris, Terry, Tom, and John for a great chat today. And thanks to our audience for tuning in. And we hope it was helpful to everyone and engaging. And we wish everyone the best for the rest of the day. Thank you.
Thank you. Thanks.